SanDisk's performance in fiscal Q4 2025 marked a decisive inflection in the company's earnings power, underscoring the accelerating role of data center demand as its primary growth engine. The quarter closed with non-GAAP EPS of $6.20 on $3.0 billion in revenue, materially exceeding management's guidance ranges. Even more notable was profitability, as non-GAAP gross margin expanded to 51.1%. Far above the company's prior outlook of 41% to 43%. This margin expansion reflected exceptional pricing power in an environment of constrained supply and strengthening demand. Revenue momentum was broad-based and accelerating. Q2 revenue of $3.0 billion increased 61% year-over-year and 31% sequentially, significantly exceeding 64% internal targets. Every business segment contributed to the upside. Data center revenue rose quarter-over-quarter, edge computing advanced 21%, consumer increased 39%, and total bits shipped grew in the low single digits quarter-over-quarter. Management emphasized that AI-driven data center NAND has now become the dominant growth driver, prompting the company to raise its exabyte shipment growth forecast to the high 60% range. Guidance for Q3 represented a further step change in expectations. SanDisk projected revenue of $4.4 billion to $4.8 billion, gross margins of 65% to 67%, and EPS of $12 to $14. This outlook signaled not a one-off earnings spike, but a structural shift toward materially higher profitability. Management adopted a notably confident tone, reiterating its intent to keep bit growth in the mid to high teens while prioritizing pricing discipline and profitability over aggressive capacity expansion, a marked departure from historical memory cycle behavior. Strategically, the company is reinforcing supply discipline and long-term visibility. SanDisk announced extensions of its NAND manufacturing joint ventures with Kioxia through 2034, committing $1.165 billion between 2026 and 2029. In parallel, management is encouraging customers to adopt multi-year long-term agreements, or LTAs, that include prepayments. This structural change is intended to smooth demand cycles and improve capacity planning. Management confirmed that one LTA has already been signed, with several more under active negotiation. Guys, 99% of people watching don't like or subscribe to the videos, so please take a second to hit that like button and subscribe. It really helps the channel grow. Financial execution during the quarter further validated this strategy. Free cash flow reached $843 million, representing a strong 28% margin, while rapid debt reduction left the company with $936 million in net cash. Management also guided investors to expect structurally higher margins over time as the revenue mix continues shifting toward enterprise SSDs and premium consumer products, both of which command significantly better pricing than legacy NAND offerings. Investor focus has now narrowed to several key variables: the durability of AI-driven NAND demand, the persistence of supply tightness, the pace of customer adoption of LTAs, and whether mid-teens bit growth can be sustained without reigniting oversupply. While the quarter clearly validated the bullish investment thesis, skeptics cautioned that current pricing and margin levels are extreme by historical standards, and that any slowdown in AI spending or hesitation around long-term commitments could expose the stock to material downside. This tension has fueled intense debate. Bulls argue SanDisk is entering a once-in-a-generation memory supercycle driven by AI that structurally reduces cyclicality. Bears counter that expectations are moving ahead of fundamentals, warning of valuation excess reminiscent of prior memory booms. For now, SanDisk stands as one of the clearest expressions of the AI infrastructure trade, where exceptional fundamentals and exceptional expectations are colliding. As of Friday, January 30th, 2026, the stock was up approximately 21%. Based on 4-hour chart data, the prevailing trend appears likely to remain intact through at least Monday, February 2nd, although some contraction could occur during that session. Even so, higher highs remain the base case. Following the earnings release, the stock is trading at approximately 2.2x its 200-day moving average, indicating extreme extension, albeit supported by strong fundamental momentum. Key supporting metrics include 64% quarter-over-quarter data center revenue growth and a 51.1% gross margin. Price pressure momentum indicators, which measure the slope of various moving averages, including the 10-period, 21-period, 40-period, and 200-period, are all trending robustly. Trend mode is currently measured at 0.25, meaning that if the stock gains 0.25 every 4 hours, it qualifies as trending. The stock is currently well above this threshold. Market grid analysis, which provides a probabilistic range of price outcomes, indicates that the stock is trading far outside its immediate range. The breakout above 564 occurred in parabolic fashion and has cleared all prior resistance levels. While the market grid may expand over time, the probability of retracement toward these ranges is currently estimated at 70%, though this outcome is not assured. The extrapolation of the 3-period moving average stands at 570, and the stock is trading at a premium to all major trend measures. The 40-period moving average suggests the stock is approximately 36.7% overextended, creating a probability band with a 65% chance of trading between 571 and 650 over the next 3 to 5 days, though this is not guaranteed. Trade setups are not recommendations and carry risk of loss. Selling rallies or shorting into strength may expose traders to losses, and caution is warranted. For those considering such strategies, an entry range of 645 to 1665 is noted, with a stop loss at 685 and downside targets at 595, 570, and 547. There is no guarantee these levels will be reached. The rationale is extreme price pressure momentum, with the 10-period moving average indicating gains of 29.71 every 4 hours, a condition that historically precedes 10% to 20% pullbacks within 1 to 2 weeks. Risk management guidance suggests position sizing at 50% of normal due to the strong fundamental backdrop. From a longer-term perspective, the preferred framework is to buy pullbacks in accumulation zones. Primary entry is identified between 530 and 550, with a secondary zone around 470. Targets in such scenarios range from 620 to 650, consistent with current levels. These setups are oriented toward a 30 to 90-day horizon and are not recommendations. Upside projections include 720 to 750 as a measured move from consolidation and 850 as a continuation scenario tied to the AI supercycle. The probability of reaching 720 to 750 is estimated at 50%, while the probability of reaching 850 is 30%. The rationale rests on AI data center demand being structural rather than cyclical, with 51% gross margins alongside 64% revenue growth creating a durable competitive edge. Any 15% to 25% pullback is viewed as a high probability re-entry opportunity, with price pressure momentum expected to normalize into a maintenance mode range of 0.15 to 0.24. The 200-period moving average is rising at 6.32%, while price momentum provides a dynamic support floor increasing at approximately $18 per month. Ideal entry signals would include price pressure momentum falling into the 5 to 10 range, successful retests of prior resistance levels, and positive divergence in momentum oscillators. Probability estimates include a 60% chance of touching 600 or below within the next 5 days, a 70% chance of touching the 547 to 559 zone within the next 10 days, a 35% probability of reverting to the 40-period moving average at 478, a 25% probability of reaching a new high of 680 within 30 days, and a 55% probability of trading above 700 within 90 days following consolidation. If price pressure momentum readings remain above 24,